Now, let's look at some economies rather, which stimulate their economy through money supply, like we have in the U.S. Case, where there's been a monthly injection of funds, quantitative easing, as they call it. Now, but here in Nigeria, the central bank seems to hold on very tightly to this money, the monetary policy issue. Now, how would you reconcile that? Because you're trying to ensure that the economy gets a boost and grows, and yet you're holding on to the rate. We saw that happened for the whole of 2013, and we're starting the year on that note again. How do you reconcile that?
Okay, let's go back. Historically, the U.S. had a recession. Recession is defined as 2 consecutive quarters of negative growth. So there was negative growth. In the European Union, there was negative growth. Therefore, you needed a fiscal stimulus to actually get that economy out of the negative quadrant. In our case, we are growing at 6. In fact, in the last quarter of 2013, we grew at 7.25%. Annualized, we're at about 6.85, right? So we have positive GDP growth. The reason why the U.S. and all these other economies had to stimulate the economies with fiscal stimulus was that because they were in negative growth. The U.S. rate of inflation is 1.8%. Our rate of inflation is 8%. So we're not in the same position. However, that does not mean that interest rates have to be increased, because when you increase interest rates, typically you will see an increase in savings. But this economy is more exchange rate sensitive than it is interest rate sensitive. So if we increase our interest rates, we do not necessarily see an increase in savings. What we see is the increase in the cost of funding, which actually negates the growth trajectory that we're trying to achieve. So yes, there are some contradictions, but and there are trade-offs. What I see the central bank doing is that they're doing this in the short term to protect the value of the currency, and we have to come back to what the naira value is in the exchange rate market. You protect that currency, and then you would assume that when it is stable, then you can then begin to grow. Right? But the issue is that it is not either or. For me, the currency could be allowed to depreciate, and interest rates could be allowed to actually come down, and then you achieve what you can call an equilibrium. But at this point in time, the central bank is taking that aggressive position to protect the currency, allow things to stabilize, allow the fiscal buffers to be rebuilt, because the fiscal buffers are the excess crude account and all the other savings of
now, how long will it take for it to be? Because we've seen the excess crude account or even our foreign reserves depleting as part of the ways to show up the value of the naira. How long will all of this take shape?
Fiscal buffers will not be rebuilt during an election year. It's impossible. Turkeys don't vote for Christmas. Politicians cannot cut back on their spending in an election year. That is suicidal. So let's assume that from now till the end of the year, spending is going to increase.
So the MPR may be held at 12% or even...
No, I don't know that it will happen, because there's a transition succession taking place in the central bank. So depending on what the new team believes, I think that what you are going to see is actually some easing of money supply to reconcile the monetary policy position with the fiscal policy position and the political objectives of the government.
Okay, now with this new policy, it means that the banks must keep as reserves 75% of all public deposits. Now, will this not affect liquidity in the system generally? Because there's always this issue of one action is taken and we have the ripple effect on other sectors, even when they're not meant to affect those areas.
Well, ask yourself, even if it reduces liquidity, it will also reduce demand for foreign exchange in the market. So the ultimate target, the nominal anchor, is the interest rate. The effective anchor is the exchange rate. So what are you targeting in this case? You are targeting the exchange rate because you think the exchange rate, because the marginal propensity to import in Nigeria is very high. Once you target the exchange rate, you effectively make the naira to appreciate in the short run. Okay. But eventually, all of these variables are dynamic. I think that the naira will depreciate marginally in the exchange rate market. I think the interest rates will come down in the second half of the year, and we'll get to an equilibrium at a level probably different from that where we are now. So we would have to accept that the naira depreciates. We'll have to accept that money supply would increase. We'll have to accept that interest rates will come down. And then from that base, we begin to build into 2015.
Now, I'm just wondering, how do you think we can actually curb that lightness for imported items? Nigerians love to have foreign goods, so to speak, and these actually fuels the desire to get foreign currencies. But if you look at our economy, we don't seem to have what it takes, so to speak, for now, to make us enjoy our locally made products, except in some few areas.
Basic economic rules are that once the price increases, the demand will reduce, except you are afraid that there will be a potential price increase coming on. So I think that as the naira depreciates, the demand for foreign goods will actually begin to decline. And then you make, it's what we call monetary policy adjustment. We are adjusting the exchange rate to actually affect your behavior. Your consumption behavior will alter. But that's a long-term thing, right? And there are many other changes that are going to take place, like the tariffs on cars and all that, which could be, in the short run, could be very disruptive, but in the long run, will be stabilizing. There's no easy solution to macroeconomic problems. So you've got to trade off some things. But at this point in time, raising the CR and raising it further, because the central bank governor said that they're going to raise it further from 75 to 100. So there's no question about that. That's going to happen. So the earlier we come to terms with the fact that the public sector deposits are no longer deposits that will be used for lending. One. Two, the earlier we accept that the currency, after all adjustments, is slightly overvalued or probably near fair value. Two. Three, the fact that banks will have to lend money and begin to actually emphasize risk management for the sake of the fact that they don't want their loan books to go bad. All of these things are things that are happening at this point in time, and I don't see any cause for panic.
Okay, I just want us to listen to the CEO of First Bank, the group MD rather of First Bank, and this issue, where he spoke from Davos close to Switzerland, giving his thoughts as regards the hike of the cash reserve requirement on public sector deposits from 50% to 75%. Let's listen in.
Face of the developments in the Nigerian environment, where you see dwindling oil revenues, you begin to see a massive amount of funds liquidity put into the system by the redemption of the AMCON bonds. I was not surprised that Central Bank and the MPC went through that route of tightening. My worry, however, is that at some point we need to begin to balance the effect of this monetary policy tightening effect and the growth of the real sector of the economy. Now, by pulling out some of those funds and increasing the public sector deposits that is sterilized in Central Bank, obviously it will reduce liquidity in the banking system. There's always a tension and debate as to whether banks really lend this liquidity into the system, but the reality is that it's worse not to have the liquidity in the banking system. So I am not surprised, and in the absence of any other tool for a regime that has insisted that they will continue to tighten so long as there is excess liquidity in the system, one should not be surprised. We need to go back, however, and say, what more things do we need to do to make sure that as we tighten, we don't starve the system of the so much liquidity that is required now to drive growth in the real sector of the economy.
Okay, that was Olabisi Onosan, the group CEO of First Bank Holdings there. Bismarck, I'd like you to just react to what so it seems to buttress your point earlier on. However, he's actually concerned as well that these banks may not have the liquidity to still lend as much as they would want to, despite the fact that this CRR is being capped.
Well, listen, what he has said is that the monetary conditions, right, and the monetary policy actually always move in opposite directions. The monetary conditions eased up because of the AMCON bond redemption. The monetary conditions eased up because of a lot of federal government money in the system. What the monetary policy does is to move in the counter-cyclical method to actually neutralize the impact of easing monetary conditions. One. But he also said that there must be other tools apart from CRR, and that has to be examined to see whether those tools can be used which are most effective.
Okay, it seems the monetary policy has always been the tool, and in this case, moving down up to the CRR, that's been more like the only tool the central bank uses to help contain whatever excess liquidity, whatever economic downside is trying to.
No, the other tool, which is what is on everybody's mind and on nobody's lips, that if you allow the exchange rate to depreciate, let us say we went from 155 to 160. For every dollar we sell to the system, we will take 4 naira more, right? So you find that the weekly or monthly auctions will be taking out more money from the system. That is the counter or the equivalent to tapering in the US. So once you allow the exchange rate to depreciate, you will find that even if the interest rates are low, there won't be enough naira to go around to create the excess liquidity that is in the system. So you can use the exchange, but the argument of the central bank is that the exchange rate, if you allow the exchange rate to depreciate, it will feed into prices, and that will create inflation. But you can't have it both ways, right? Okay. So you got to, how much of the exchange rate depreciation are you going to allow? One, and how much of the interest rates lower are you going to allow? So that, but the ultimate objective is to have a fast-growing economy with macroeconomic stability. So you use the exchange and interest rate regime to create stability, while you use the fiscal stimulus to actually catalyze growth.